Hello and welcome to our August 2023 market update. So let's take a look. First, here's the Dow as of the 16th. Year to date now, as you can see on there, about a little under 6%. The Standard & Poor's 500 is the leading of the two majors, up 15 and three quarters. And the star for the year has been the NASDAQ, the over-the-counter, dominated by the big technology sector, up about 30%.
Wow, so double the S&P.
Double the S&P, six times the Dow.
Wow.
Wow. We've moved a lot, and here's part of the problems we're looking at right now. You'll see in a second we're going into a seasonably weak time. But if you look at this chart up there, you can see it looks like the Dow has hit a peak and started to turn over. It's likely to see a pullback of anywhere from 3 to as much as 10%, most likely in the 5% area. But right now, nothing fundamentally wrong, doesn't change a bull market. It's just after that big run, the market needs to rest. So you can see the 20-day moving average has already turned over. The 50-day hasn't yet, and both the 50 and the 200-day moving averages are still headed upward. So let's look at what we have this month in the market. Max is going to cover inflation, the Federal Reserve, and jobs. All right, Max?
All right, so this month in the market, a cooler July inflation report came out and opens the door to a Fed pause rate. We'll see what happens in the coming months regarding the Fed and if they're pausing in their rates. A lot of people are talking about a Fed pause rate next month, but we'll see. Actually, the Fed is coming out and talking today, and we'll see what those minutes have. So as you can see in the chart, the core inflation was at 4.7%, and the overall inflation was at 3.2%.
And right now, remember, the core takes out food and energy. Mm-hmm. So we may see that, not the core move up, but the overall, because how are you seeing gas prices, Max?
I don't see them much. I
man.
drive a Tesla.
Okay, I see gas prices going up. Okay, all right. Is there any benefit to falling inflation?
Yeah, but go back a slide real quick, Vic.
Okay.
So if you can see, remember at the high water mark, we were at 9.1% in inflation. And that was the high water mark. So we can definitely see we're coming down. So I think what Jerome Powell's doing is working, and as you can tell by the inflation. But a big thing is right now, rents, remember, make up around 40%
of the market.
So rents make up 40%. So once those start to continually go down, rents and housing, once that continually starts to go down, then we'll see continually fall in inflation.
Yeah, now there are some hot spots around the country, South Florida being one of them. But around the rest of the country, you're seeing weakness in housing prices and rent.
And actually, lo and behold, New York is also one of the hot spots.
Yeah.
So.
Oh, and wasn't Tampa in there?
Tampa's big.
That was a surprise.
Yeah.
Okay.
All right, so the benefit of falling inflation. So hourly wages have rose 0.3% in July, the fifth straight month of gains in real incomes. Real hourly wages are up 1.1% in a year, owing to the high levels of inflation in the previous month. So wages are coming up, so people are making more money. It's a good thing right now, especially with inflation, but has it caught up to inflation? No, not yet. We're only up 1.1% in
and
inflation.
We're up, as you just saw, 4.3 on the
4.3 in inflation. So hopefully at one point they will intersect, but we'll see what happens there. So near-term market issues, we'll go through these. China seeing disinflation as their economy feels impact of COVID closures over the last 2 years.
And didn't we just talk about the real estate? What's happening in China's real estate?
Yeah, China's real estate is no bueno, no good.
That doesn't sound like Spanish. I mean, like Chinese.
Like Mandarin, no.
Exactly.
We switched the country on it. So, yes, China's construction is not doing well. China housing is collapsing. We'll see what happens out of that. A lot has to do with what's happening with their underpopulation and overdevelopment of housing.
Right.
So then we have concerns about the credit tightening in the banking sector, historically a front runner of a recession. We'll see what happens. We had Goldman come out and say in next year next year. In the beginning of next year, they're thinking of
looking for
lowering
cuts,
rates.
yeah.
So that implies that we're going into possibly a recession.
Yep. Hopefully a soft. There's more
Soft,
and more
there's
data
more
coming
talk.
up for a soft recession.
Yeah. So issues in the trucking sectors. So Yellow files for bankruptcy and UPS settles a possible strike. UPS drivers. So if anybody's looking for higher wages, UPS drivers are now paying $170,000 a year.
Are they really?
Yeah.
Oh my God.
Yeah. So
I'll be right back. I gotta get drive.
So Yellow files for bankruptcy. Usually when trucking companies file for bankruptcy, that's a sign or an indicator also of a recession possibly down the road. So jobs still healthy, but AI offers a potential to replace some of the lower end labor shortages.
So you mean my next waiter could be a robot?
See, I think it has more to do with white collar than blue collar jobs for AI. What do you think?
Yeah, I think it's going to be more white collar. It's very hard to get a robot to be a plumber or a carpenter or a welder
Or a nurse
or a nurse.
yeah.
So
So
those type of service sectors are much more reliable individual people. The AI, I think, is going to be a lot of administrative issues.
So CPI, as we just discussed, inflation is cooling, taking pressure off the Fed to increase rates. We'll see what the Fed goes out and does. I don't think I'm in the camp more that they're not going to raise rates next month.
Yeah,
What do you think?
I'm flat for next month.
You're the flow cut.
Yeah,
So we're on the same page.
And by the way, with inflation cooling, I don't know about you, but that's the only thing I've seen cooling lately. Everything else is hot.
Yeah, you walk outdoors and boom, you're hit. You're starting to sweat.
Yeah, you got free sauna. Okay.
So earnings season, 80% of the companies that have reported have beaten their earnings expectations. That's important. So that's from FactSet. So after a strong run led by the technology, we believe is a pullback likely. We've seen a pullback already in the month of August. August, September, and October, those 3 months are usually slower months for the market.
I think that comes up right here.
So sorry.
No, that's a perfect lead in.
Yeah, perfect lead. After a strong led by technology right there. So those seasonally, those are 3 lower months.
Yeah, if you see that since 1954, look at what you got down there in the 3 weakest months. It's actually August, September being the worst,
September's the worst.
and October.
Yeah.
So, yeah, that's why. Do we expect some weakness after one, a very strong market, and second, seasonable weakness? Absolutely.
Yeah. All right.
All right. Oh, one of the things, you hear a lot about AI, artificial intelligence, and basically it boils down to one thing. You either adapt and improvise into it, or what happens if you don't?
You get left behind.
You get left behind. We're now using artificial intelligence in our practice. We do estate planning analysis. Now you take your wills, your trust. It'll create a snapshot, shows how things are going to pass. It makes it so you understand the current structure. It puts it into one elegant report, gives you planning opportunities and things to do to make it more efficient. I mean, sometimes we see trust and the successor trustee died 5 years ago, but they never got it around to updating it.
They never got around to it?
I got round to it, as a matter of fact. All right, I'll do the history. This is kind of a busy chart, but I just want you to notice 2 things. On the top, you see all those blue mountains. Those are bull markets. They last an average of 6.5 years. And if you see underneath it, see those little yellow things? You can barely see them. Those are bear markets, down markets. They last in an average of 11 months. So average bear market is 11 months. Average bull market is 6.5 years. We've just finished coming out of a bear market. So we're likely to see a strong market for at least the next 3 to 6 years. And here's the difference. Everybody knows this. Every professional athlete and all teams have coaches. Why? Because doing it yourself does not give you the ability to be the most that you can be. And look at this, the average market returns. This is by Dalbar, a 20-year study. It's not ours, it's an outside source. Average market returns in that 20 years, a little over 6%. What was the average investor's result during that period?
We'll give them 2%.
We'll give them 2%. 2% versus 6, 3 times better with a professional coach. And here's the deal. We tie it all together. Why? Everyone knows this one. Those who fail to learn from history are doomed to repeat it. Those that do learn from history can prosper. We bring in the historical context. And that's what you need to do.
We bring in the historical and take out the emotional.
And take out the emotions, absolutely, because that's what really messes people up. So when you tie it all together, we've got some upcoming on-demand seminars, navigating Social Security, optimizing benefit, taxes in retirement, estate planning today, learning to craft your legacy, and savvy IRA planning. All of them will tie together tax planning, which is very important. And then when you put it all together, why are we here?
We're here looking out for you.
All right, thanks for joining us
Thanks
today.
for joining us.
Bye-bye.